Our General Electric to spin off its healthcare unit, and it's getting out of its stake in Baker Hughes. Kenny Polcari is here on the floor of the New York Stock Exchange. All right, Kenny, what's your reaction?
Listen, it's exciting news, right? The stock is up $1 in pre-market trading. I think investors are looking at it as GE kind of going back to refocus on its core business, and because I think under Jeff Immelt, the company just got too big, too lethargic. It didn't know what it wanted to be. It was trying to have its finger at everything, and it came back to bite them in the backside, one way or the other. Now, Flannery is trying to clean it all up and focus once again on renewable energy and jet engines, exactly kind of where they should be. So I think it's a positive move. I think General Electric is an icon in this country, so I think there's going to be a lot of excitement around it, behind it.
And in some news reports this morning, GE saying it will adjust its dividend. Do you avoid the stock?
No, I wouldn't avoid the stock. Listen, you have to expect, if you're in that sector and you've been following GE, you've seen what's happened, you understand the issues they're with, and so they're going to have to make some adjustments. But it's just going to draw maybe a different investor, right? Someone that's just buying the stock for the dividend may not be the right investor for GE at the moment, but someone that's looking for growth and the opportunity certainly will. So I'm not necessarily completely disappointed in that announcement. I actually think it's something that has to happen.
All right, let's talk about tariffs. Was the sell-off in the market on Monday an overreaction?
Listen, we can go both ways on that. I'm not necessarily sure it was an overreaction based on kind of what the papers read, what Mnuchin came out and said. He starts saying that that the administration was going to target any country that was stealing technology, when in fact that wasn't the message at all. And that came out yesterday at 3:30 when the markets was at its lows, both on the Dow and the S&P. After breaking some technical levels, they sent Peter Navarro of all people out to try to calm the markets down, to talk about, no, it's wrong, that the policy is targeting specifically China, as was made clear in the May 29th statement that the White House put out. And so therefore that seemed to help stabilize the markets. But look, the market technically had a couple of breaks. We broke the 50, we broke the 100 on the S&P, we traded well below it, and even though we rallied and closed above it, the sense is after that break, technically that the market's going to have to test it again just to see if the buyers will defend the position. And so don't be surprised if over the next couple of days or the week that you're going to see that happen.
But then this morning we have President Trump threatening tariffs on Harley Davidson, so where's the market sell-off there?
Well, so listen, and you might see that specifically in just Harley Davidson, right? You may not see it in the broader market. But look, I actually think that Harley Davidson also maybe have overreacted, because in the end, I don't think this trade war stuff is going to be a trade war, the trade war that everyone's expecting it to be.
You think the market could withstand some of this rhetoric?
Well, I think the market can withstand it. Listen, it may get uglier if the rhetoric heats up, but in the end, I don't think we're going to have a trade war. So therefore, I think that some investors or some companies, i.e. Harley Davidson, might in fact be overreacting, because in the end, I think this whole tariff thing is going to go away. I think EU is going to pull them back. I think the United States is going to come to a better understanding, and so therefore, I think all this is a lot more noise than it is meat.
So where would you be putting money to work right now? What sectors are you watching?
Well, listen, tech is always a sector you want to put in, especially after yesterday. We had some pressure on tech, but I think tech is going to be one of those sectors that continues to outperform. So I'd be tech. I'd look for the financials. Consumer staples is another sector that's rearing its head, right, and kind of waking up. I think you have to be careful with industrials at the moment just because of the rhetoric. Once the rhetoric cools down, then I think there's going to be an opportunity in industrials as well, because some of those names have gotten really beaten up as a result of the rhetoric. But if the rhetoric cools and everyone comes, the cooler heads prevail, I think there'll be some opportunities there. But right now in the short term, I'd be looking a little bit more defensive, so I'd be looking at tech and some of the financials and some of the consumers, and maybe even some utility.
Because even the Russell 2000 got hit on Monday, and that sector was thought to be safe from trade worries.
Well, that's right, but you see what happened is the whole market got hit, right? So even though it's safe from trade wars, because that will bounce back quicker as a result, because it is safe from trade wars, but when people get nervous, when people think, the market's going lower, they're going to raise some money in stocks that have outperformed. And the Russell, like the NASDAQ, is up 9 or 10% year to date. The Dow Industrials is negative 2%. The S&P is just up 1.6%. And so therefore, if people are looking to raise some money, they're going to raise it out of sectors that have outperformed and then take that money and reinvest it in sectors that have underperformed. So it makes perfect sense. That NASDAQ came under pressure, that Russell would have come under pressure, but those two will bounce back faster, I think, than the broader market.
All right, Kenny Polcari, we'll leave it there. Thank you very much.
You're very welcome.